I've been at Colliers for about 5 weeks now. I was previously with another firm for about 14 and a half years based in Prague. I've been living in Prague for close to 19 years now. My family's Czech, half Czech, half English now. And yeah, I've been in the region, in the CEE region for quite some time, and actually this year celebrates sort of 30 years since the fall of the Iron Curtain. And what's amazing is to see the rapid pace that this region has undergone over that 30 years. It's quite phenomenal. We were just talking before about, for example, the Warsaw skyline and the differences that people have seen, just even in the last 20 years. So these are just a few headlines, and these headlines really are not exclusive to Central and Eastern Europe. They're very common themes across most of our markets, across Europe and globally. And I just thought, as I said, I just wanted to put a few up there because it's a very, very busy space, particularly when we're investing or occupying into real estate. There's so many things to think about, or things that can impact on our decision making. So economies and cycles, we're obviously in uncharted territories. We're into a sort of 10-year investment cycle, real estate cycle now. Economies are very, very strong. They are starting to cool off, and we'll talk about that in a minute. Lots of political noise, lots of things going on around the globe, which could tip the balance in some regions or countries and cause some issues. Brexit, we won't talk about that. Chexit, that's also been something that's talked about. Once Britain does decide what it wants to do, will other countries decide to follow it? With populist governments out there nowadays, there's many things are possible. CEE has a massive car industry, and obviously that is a bit of a concern. Some economies are heavily reliant on the automotive industry. We'll touch on that a little bit. Data and technologies, obviously impacting the way we work, the way we do things, the way we make things, the way we buy things, and of course that's also creeping in and having some quite profound effects on real estate. So such as online sales. Trade wars will also come into it a little bit. Supply chain fulfillment is having a massive impact on retail, but also rising costs. As people's wages grow, the costs of delivering real estate, the cost of delivering your packages, the cost of manufacturing your goods, these are all rising. As a result of that, we can expect some increase in rents. We can also look at the possibilities of other people looking into other alternative asset classes, amongst other things, and a few other factors that are impacting, such as shortage of housing, shortage of materials, and prices rising in the housing sector, but also lack of land and availability and permitting. So a lot going on. So let's look at the economies across Europe, but specifically focused on Central and Eastern Europe. The red is obviously where there's very low economic growth, and automatically there two countries stand out. Italy, there is not. That's always been the case for some time now. But Germany, and this is a 4-year forecast on average looking forward. So Germany is a bit of concern because for Central and Eastern Europe, most of the economies in the region are quite linked to Germany, particularly from a manufacturing perspective, but also demand perspective. So that whilst Germany has had a long run and a very good run, its growth forecast is a bit lower. So there is a concern for us, but still the Central and Eastern European economies have diversified quite considerably over the last couple of decades, and we believe they're more robust. And in fact, for example, Poland during the global financial crisis, Poland was one of the only countries in Europe that did not go into recession. Now, looking at retail sales, so there's a lot of, the Central and Eastern European economies are enjoying the money that they've got. They're spending it, which is great for the economies. And as you can see here, the blue figures, particularly Poland, Czech, Romania, Bulgaria, Serbia, they're spending an awful lot of money on goods and services. They're enjoying themselves. So that's very, very positive. Other parts of the region are less so. So there's less growth there. But again, this is very, very good news for the retail industry in Central and Eastern Europe. which is actually performing pretty well. Now, unemployment, this is a double-edged sword. So, as you can see here, countries like the Czech Republic have very, very low unemployment. Now, that's great on one hand because it means that anybody who wants a job has one or can get one. But on the other hand, this does mean for the office and industrial sector, it's sometimes quite difficult to actually to find new employees. And of course, wage increase is going through the roof. So again, it's becoming more expensive for corporate occupiers, for manufacturers to employ staff, and therefore the cost of goods and services are also rising. So moving on to the investment markets. So as I mentioned, we're into roughly what's a 10-year cycle starting from about here, a little blip in 2011. But essentially, we've basically been growing in this region. And just before I go any further, by this region I mean Poland, Czech Republic, Hungary, Slovakia, Romania, and Bulgaria. Now, as Colliers, we do have offices elsewhere, but for purposes of this data, we're talking about those 6 countries mainly. So. Poland, again, being the largest market in the region, close to just short of 40 million, about 38 million people. Again, it's unsurprising that there's a bit more assets in the country, and therefore we should see more demand. But certainly, Poland makes up for about 50% of investment volumes across the region, followed by the Czech Republic, Hungary, and then Romania, Bulgaria, and Slovakia. So we're about 9 million for the year, for the first 3 quarters of the year, and we're optimistic that we will come close to around the 13 billion mark. It's still quite a way to go in the last 2 months of the year, but we could fall just short of it. Again, we'll come on to it in the next slide, but there is a distinct shortage or a reduction, obviously, in the amount of retail that's been traded in the last 18 to 24 months. It's shrinking. Again, investor confidence in retail, not just in Central Europe, has dropped. Although we are reasonably confident about that in Central and Eastern Europe. Looking at where the money is coming from. So, historically, a lot of money in the region has come from the UK, Germany, Austria, European players, but also the Americas. Americas have been net sellers over the last few years. But certainly, we've seen over the last sort of 5 years quite a bit of money coming from South Africa that has reduced, and that's been replaced by Asian capital. So we've seen obviously Singaporean. GIC, sovereign wealth money, but also quite a bit of Korean capital in the last 12 to 18 months, although we can talk about that maybe a little bit later, but that is also starting to slow a little bit. Malaysian money, Malaysian pension money has also come in. So it's quite a diverse group, but also most importantly, we've also got quite a lot of CEE domestic money, money from the Czech Republic, Hungary, investing into its own markets, but also cross-border within Central and Eastern Europe. Some countries like Poland don't have a REIT structure yet. Pension, insurance money cannot at present invest into real estate. So again, if those things change, we will probably see a bit more money coming from places like Poland and elsewhere. But as I said, there's a mixture of a good mixture of sources of capital, and some of the bigger players are mentioned down there: Nephew Rockcastle, Union, Globalworth, GIC, CPI Group, which is a Czech-based group, CAMO, Ryco, which is a Czech REIT, Blackstone, Starwood, for example. So these are some of the biggest players that have been investing over the last 10 years. Some of those have exited already, and some of those are fairly new to the market. Again, just looking at sources of capital is something that we found quite interesting, and this is preprint data. As sort of core plus assets are more scarce or more difficult to find these days. So we find that investors are adjusting their strategies in accordance with the market. So there's quite a bit of dry powder out there, but as you can see, it's very difficult to see with the colours. But again, some of these private equity firms now are looking more into the opportunistic and value-add properties as they chase returns. Also, interestingly, is some data here on fundraising. Now, whilst we do expect, this is just 2009 year to date, whilst we do expect those 2019 figures to increase, the interesting fact here is that whilst we could see increase up to basically more funds raising money, but actually 80% of those funds raised are raised by 4 groups. So that wealth is consolidating into very small pockets, or very large pockets, but a smaller number of pockets. So again, and those groups will be typically targeting platform, potentially portfolios. So some of those bigger tickets might be swallowed up by these groups, but there will still be opportunities going forward. But for those smaller ticket numbers. But again, there'll be increased competition from these larger groups. So yields, where are they at today? So this is just a comparison of where they were pre-global financial crisis in 2007, and where they are at the end of September this year. So with the exception of a very few in Romania, on offices, Bulgaria, I think they're on, and Hungary on logistics. We are, most of the markets, as I think across most of Europe, we're definitely way beyond where we were in 2007. We're definitely in a different time than we were in 2007, hopefully. But again, these numbers are quite high, quite sharp. But still, in comparison to other benchmarks, so if we're just taking the 10-year Euro bonds, which are basically returning close to zero at present. Here we've got a German blended yield, which is sort of a blend of Frankfurt, Munich, Hamburg, and Berlin. This is on offices, by the way, prime office yields. So you can still see there's still a reasonable spread from Warsaw and Prague here, way up to Bulgaria there, both on the bonds. And from prices CEE to Germany. German office yields around the 3% mark at the moment, and Prague, so at around Prague, Warsaw floating around the 4.25 mark at the moment. So yes, it seems quite expensive, but the fundamentals in the market are very strong. There's low vacancy, very high demand. Some of those other factors, such as rising costs, are pushing rents forward. So there is some capital growth there, which is not driven purely by yield compression. So, and again, there's a fair spread between the different markets at the moment. So pre-financial crisis, there was quite a convergence there. So some of those sort of slightly outer line markets, we could expect to see a bit more compression there, but with regards to sort of Prague, Warsaw, maybe a little bit more. The Koreans certainly helped to reprice some things this year, but again, I wouldn't see too much more at the Prague, Warsaw level. But we said that before the Koreans entered the market. So just to recap, so we're still in this very low interest rate environment. Real estate continues to be viewed as an attractive asset class, as opposed to other more, let's say, risk-averse strategies. And again, the markets in Central and Eastern Europe, the fundamentals are strong, economies are strong at present, and investors like that story. There's a lot of capital out there that is not placed. I think last year, I said there was the investment volume was around close to 14 million, but there was about 60 billion. There was about 60-70 billion in underbidder money that was not placed, that didn't find a home. So it's not about shortage of capital; it's more about shortage of assets. Is is the issue at the moment. And then just onto a couple of last topics, just that are interesting for the sector or interesting for the region. Now, most of the markets in Central Europe, those that are in the European Union, joined in 2004. Romania, Bulgaria joined in 2007. Now, this is basically the percentage of the population that were living in the country in 2018 or left the country in 2018. Sorry, 80, and the lighter blue number is those that basically left those markets in 2018. So Romania and Bulgaria, yeah, quite a large exodus from those markets. And then said that, it's a bit of a sliding scale there. UK most of you seem to like to stay where you are, as do the Germans. But in some markets, where labour shortages are coming to a head. We would like to see some of those people returning if they feel like it, and hope, because there are some good quality of life. So most people who left maybe could be 10, 15, 20 years ago when these markets were quite different. I said coming back, the quality of life is still good. Depends on what they've appreciated, what they've felt in the markets that they moved to. But income is growing very quickly in Central and Eastern Europe. The cost of living is still pretty decent, although house prices are rising very fast. So some of that is negated there. But some of the local currencies are suffering, let's say, or appreciating against the euro and the pound. So there's maybe some foreign exchange benefits there. Sometimes there's some lower, in some markets there's lower income tax. So there's a few attractive reasons why some people should consider moving back to the region. But also, some people also complain that moving to Western Europe, they have some issues with languages or status and some things. So if they're not feeling comfortable, there's always room for them to come back. House pricing, inflation. This is Eurostat data. It's incredible how rapidly things have moved. Again, they're coming from a very low base, but still, if you bought a house or an apartment in Prague or Warsaw a few years ago, in some cases your property price would have doubled. And again, for the average person, it's quite challenging now with supply constraints and these price movements to actually afford, let's say, a starter home. Now, some say that the young people today don't really want to buy homes, or wait until they have some responsibilities, and then they'll probably change their minds. But the point is that in some cases governments have had to, and central banks have had to put in place some measurements to help protect the economy, because again, like I said, we're in a very low interest rate environment. People are borrowing on those very low interest rates, and should interest rates move on the mortgage markets out to 3%, which is still massively different from when I started my mortgage around 5 or 5 plus some years ago. We could start to get into some serious trouble. So for example, the Czech National Bank implemented a policy whereby you can only borrow up to 9 years your gross income, and that repayments of your mortgage can only be up to a maximum of 45% of your net income. Again, to protect that. So actually, in putting that into place, they've wiped out a third of all buyers from that, especially that lower end. And nowadays, you can sort of see. So, for example, the average new build apartment in Prague at the moment is selling for about 4,000 euros a square meter, which is phenomenal. Because there's basically nothing cheaper on the market, because they all go sold very quickly. So some issues there. Now this is, I must admit, this is slightly misleading because, and this is just clean hourly cost. This is without employer addition. So, for example, in the Czech Republic, about an additional 30%, an employer will pay an additional 30% on top for social and other contributions. So, but nonetheless, the reason why the region is still so very attractive is because despite that, despite the additional up to 30% in some cases, but that'll be the same for some of the other markets in Europe, labour costs are still considerably much cheaper. Whilst they used to be about 1/3, and nowadays it's roughly about 50%, it's still a massive gain in savings. And again, we're talking about markets here who have incredibly high levels of education, a very skilled labour force. So these are not locations anymore where people are just processing invoices. It's gone way beyond that. And in fact, the business services industry in this region, in most markets, are one of the top, or certainly within the top 5 employers in those countries. So I think in Poland now, I think it's close to 300,000 people, I think, in that industry. Just a couple of last ones. Co-working flex phenomenon. Again, this is certainly taken the office markets by storm over the last few years. There's a lot of some positives and some negative news about the flex industry and providers. But this is something that is here to stay. The question is obviously some of the covenants of these operators is under question, and how strong some of these companies will be going forward. But certainly this is helping the CEE region in the sense that where companies want to move into these markets, or on a small scale initially, this sort of space as a service can help companies do that quite rapidly. Another one, it's a bit of a complicated slide, but I'll just try and I just like this one from Prologis and the Sequoia Group. They're looking at very much into supply chain, particularly around retail. On the left-hand side, you've basically got your model around typical retail and bricks and mortar stores. On the right-hand side is an typical e-commerce platform from their study. And what it shows really is that, whilst the standard retail platform has its issues, and again, customers spend a lot of time in stores. On the e-commerce side, whilst customers spend a lot less time, physically going to the store, etc., but doing more browsing online, actually the cost of operating is phenomenal on e-commerce, and it's still relatively at its early stages, mainly because you've got these massive distribution warehouses, but on top of that you've got your return centres, your fulfillment centres, and the cost of operating these is huge. In addition to that, you've basically got just a massive distortion in stock. So a typical example is obviously where there's a T-shirt. It comes in 7 colours. A typical customer would take all 7, decide he wants the white one or she wants the white one, and send all 6 back. The other 6 back. Now, in the olden days, the system, or the supply chain system, would have said, we've just sold 7 T-shirts, create 7 more. But then 2 weeks later, 6 come back into stock, and we're oversupplied by 6 T-shirts. So, this has had a massive knock-on effect to the point that we're in the trillions of dollars of oversupply of goods in some of these systems. And we're already starting to see some of the problems that even those pure online players like ASOS, Zalando, but also some of those who have omni-channel are having. So the point of the story here is that retail, there is a future there. There is a lot of work to be done to getting these models correct and to find that balance between bricks and mortar and pure logistics and online supply. But it's a very fascinating very fascinating look at what Colliers there has done. So just to wrap up, outlook for the remainder of the year and looking forward to next year. As I said, there are some headwinds out there, but the economies are still doing very well in the region. We do see rents pushing upwards. As I said, there is some supply constraints in some markets. Costs are also helping to push those prices up. Wage growth is positive for retail, that people are still spending their money and enjoying it. Development pipelines, despite shortages of labour and materials, is relatively strong going forward. So again, there will be a product to buy. Rate rises in CE, again, will affect some funding, but again, there is a little bit of room to compress a little bit, as I mentioned before. And as I said, those occupier markets, particularly for office and industrial, are very strong. On the downside, any sort of interest rate moves, again, and risk of inflation, will put pressure on some pricing. E-commerce, again, does continue to impact on the markets, although at the moment in Central and Eastern Europe, I think the maximum is about 10%, up to about 10% share of overall retail sales at the moment. Wage growth, as I mentioned, is negative potentially for those BPO shared service centres where they are very cost sensitive, but there's a huge amount of investment gone into a lot of these centres, and I don't think they'll be sort of moving elsewhere too quickly, too soon. Product availability is the main issue rather than investor appetite, but also sellers' expectations at the moment are quite high. And as I said, demand versus supply. Of course, if you're holding on to assets today and they are turning over a good income, then if you sell it, the challenge is what you're going to be able to buy next. So again, it's an interesting time. Some ups and some downs, but our view really is generally quite positive. That's it for me.
Thank you.